You walk into a bank and ask for a loan. The banker types a few numbers into a screen. Seconds later, the money appears in your account. You assume it came from somewhere. A vault. A pile of savings from other customers. Something physical, sitting in reserve, waiting to be handed to you. It didn't. That money didn't exist 5 seconds earlier. The bank didn't move it from another account. It didn't pull it from a stack of bills in the back room. It typed a number, and the number became real. Right now, that sentence probably feels wrong. How could a private company just create money? Isn't that the government's job? Here's where most people stop thinking. They assume banks are middlemen, storing your cash and lending it back out. That belief feels obvious. It's also almost completely backwards. Start with the version of banking you were taught, probably without anyone directly teaching it to you. You deposit $100. The bank keeps a small percentage in reserve, then lends out the rest to someone else. That borrower deposits it somewhere, and the cycle repeats. Economists call this the money multiplier. It's clean. It's intuitive. It's in almost every introductory textbook. It's also not how modern banking actually works. In 2014, the Bank of England published a paper that quietly upended decades of economics education. It was called Money Creation in the Modern Economy, and it stated plainly that the reality of how money is created today differs from the description found in some economics textbooks. Banks do not wait for deposits before they lend. Lending comes first. The deposit is created at the moment the loan is made. Read that again, because it changes everything downstream. When a bank approves your loan, it isn't searching its vault for spare cash. It's making a simultaneous entry on both sides of its ledger. One entry says you owe the bank money. The other says the bank owes you money, in the form of a deposit sitting in your account. Two numbers, created together, out of nothing but a decision. That decision is money. Not paper, not gold. A decision, recorded. So where's the mechanism? What actually gives that decision power? Trust. And a very specific, very engineered kind of trust. Every bank operates inside a system where its promises are treated as equivalent to physical currency. When a bank says you have $5,000, the rest of the economy accepts that claim as if it were 5,000 physical dollars. Because every other bank, every merchant, every government agency has agreed to treat it that way. Money, in this sense, isn't a substance. It's a shared belief, backed by contracts, regulation, and a central bank standing behind the whole structure. That's layer one uncovered. Money isn't minted into existence by a government printing press first, and then distributed. Most of it is created the moment someone signs a loan agreement. But why would anyone design a system this way? Why would society hand private banks the power to conjure the thing everyone depends on to survive? Because it solves a problem that gold and printed cash never could. An economy needs its money supply to expand as activity expands. A farmer needs a loan before the harvest exists. A factory needs capital before the product ships. If money only existed in fixed physical quantities, growth would be strangled by scarcity. Economist Hyman Minsky spent much of his career studying this exact tension, arguing that credit, not currency, is the lifeblood of a functioning economy, and that financial stability depends entirely on how that credit is created and managed. Bank-issued credit lets an economy grow ahead of the resources that will eventually justify that growth. It's a bet on the future, made real today. But a system built on bets has a hidden cost, and this is where the deeper layer starts to surface. If banks can create money by issuing loans, what stops them from creating too much of it? What stops the whole system from spiraling? Two things hold the structure together, and both are far more fragile than people assume. The first is regulation. Central banks set capital requirements, forcing commercial banks to hold a cushion of their own funds against the loans they issue. This doesn't stop money creation. It limits how aggressively banks can do it, acting less like a locked vault and more like a speed limiter on an engine that would otherwise run without restraint. The second is confidence. And confidence is the part nobody notices until it's gone. Economist Hyman Minsky's work eventually became known as the Minsky moment, the point where a financial system that has been expanding credit smoothly suddenly reverses, as confidence collapses, and lenders stop trusting the very promises they created. In 2008, that moment arrived. Banks had spent years generating enormous quantities of new money through mortgage lending, betting that housing prices would keep rising forever. When that belief cracked, the created money didn't just stop growing, it started disappearing. Loans defaulted, deposits evaporated. The invisible machinery that manufactures money in good times became the same machinery that destroys it in bad times. This is the deepest layer, the one that reframes everything you thought you understood about a recession. A financial crisis isn't simply people losing their savings. It's the money supply itself contracting, because the money was never a fixed pile of cash. It was a web of promises, and when enough of those promises broke at once, some of the money simply ceased to exist. Feels strange to sit with, doesn't it? Economist Richard Werner ran an empirical study in 2014, working directly with a bank to trace, step by step, exactly what happened on its books when it issued a loan. His conclusion matched the Bank of England's description almost exactly. The loan created a deposit instantly. No pre-existing pool of savings was tapped. No reserves were physically moved. The bank simply expanded its own balance sheet, and in doing so, expanded the money supply of the entire economy, which means every mortgage, every business loan, every car loan financed through a bank is quietly adding new money into circulation. And every loan that gets paid off is quietly removing money from circulation. The money supply isn't static. It's breathing, in and out, driven almost entirely by decisions made inside private institutions, guided by regulation, but ultimately powered by trust. Now connect this to your own life. The interest rate on your mortgage isn't just a number chosen to be fair. It's a lever central banks pull to control how fast new money gets created across the entire economy. When rates rise, banks create less new credit, because fewer people can afford loans. Growth slows. When rates fall, banks create more, because borrowing becomes cheap. Growth speeds up, sometimes past the point of safety. Every time you've heard a news anchor mention a rate hike or a rate cut, you were hearing an update on the exact mechanism that manufactures the money circulating through your paycheck, your savings account, your rent. Inflation, too, becomes far less mysterious once you see this. If banks create too much new money relative to the goods and services actually available to buy, that new money chases the same limited supply of things, and prices rise. Inflation isn't just stuff getting expensive. It's often the visible symptom of an invisible acceleration in money creation happening behind the scenes of every loan approval in the country. So the next time you deposit a paycheck, watch it move through a system built almost entirely on ledgers and trust, rather than vaults and cash. The dollar sitting in your account isn't stored anywhere. It's a promise, recorded, trusted, and quietly capable of expanding or vanishing depending on decisions made far from your view. You didn't imagine that banks hold your money safely somewhere. You just never noticed that the safe was never full to begin with.